It was an ugly day on Wall Street with stocks down across the board. In fact, the Russell 2000 was down 3.69%, which made it its worst day since June 11th. We also saw the worst day for the Nasdaq in several months. So tough day across the board. All sectors were lower. So we'll take a look at all that, see how it affects our posture. Then I wanted to show you an interesting educational example of a put sale and how the different components of the options pricing model works and can work to your advantage if you're looking for the right circumstances. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's February 25th, 2021. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down to our description area and sign up for our email distribution list. Remember, in those daily emails that we send you, it's not only a notification that the video is now available for you to watch, but we also include the overbought and oversold clusters within that daily email. So I imagine there's going to be a whole bunch of oversold clusters here within the S&P 500 today. We're also heavy users of Twitter. My handle is @BrandonVanZ. On days like today, where there's a little bit more market chaos, I tend to get onto Twitter and share my thoughts a bit more. So make sure you're following me over there to learn from me between my presentations and classes. And we certainly appreciate those of you that click like and retweet on these Market Outlook related tweets. And then last but not least, we also have a presence over on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's jump into today's action. And I wanted to start us off here with this view of the S&P 500, and it'll give you a pretty decent sense. Actually, you know what? Hang on just a second. I want to see if this is the right one. There we go. That's the S&P 500. Same picture. The point being that it's very red out there. There wasn't a whole lot of green. In fact, the decliners led the advancers to the tune of 7-1 here today. Really, really ugly price action. We saw Tesla in the dark red right here. The darker the red, the further they fell. And so with Tesla, it was down 8% today. Nvidia was down 8% today. Boeing was down 5% today. And even some of these big kahuna types of companies like Facebook was down 3.6% today. Amazon down over 3% today. Alphabet down over 3% today. Even Apple down over 3% today. And Microsoft, I guess, a relative winner, down only 2%. But the point is, it was a bloodbath out there. And a lot of the big tech world that tend to have acted like Teflon in prior market meltdowns actually succumbed to the market weakness and pressures here recently as well. So there wasn't a whole lot of green to be found on the board today. There was maybe a little green slot right there with Twitter. Some of you might have heard that they are aiming to double their revenue over at Twitter and are going to be announcing some new features, including super followers and a few other things that they announced. So the market cheerleaded that on. Twitter was up 3.7% today. And, you know, you had T-Mobile up 1%. Deere was up a little bit. Some of you saw my tweet the other day with Deere raising their dividend a pretty healthy amount, 18%. Looks like CME was up. Remember, a little bit more options trading activity and things like that can help some of those exchanges. So they were up 2%. But for the most part, I think this picture is pretty clear to you right here. This was a really ugly day across the board. Another thing that we can look at to kind of gain that understanding is coming up here to the visualization area of the Thinkorswim platform. Rather than going to the heat map that I'm on right now, let's go over here to the index watch. And I've got the NYSE, or the New York Stock Exchange, pulled up here. And you can see up at the top, it's got the advancers versus the decliners. There were only 365 advancing stocks within the New York Stock Exchange here today. There were over 2,300, nearly 2,400 stocks that fell today. So that was nearly a 7-1 differential there between your decliners versus your advancers. So again, another sign that things were really, really ugly here today. And then let's take a look at this chart. I usually like to bring this one up whenever we have a day where we're moving at least 1% in either direction can kind of start giving us a sense of how volatile markets have been here recently. I've got the Russell 2000 pulled up this time because of what I mentioned in the intro. I just wanted you to see how ugly of a day it was today. The Russell 2000 was down 3.69%. And you can see that this red candle is falling from that black zero line down below this horizontal fuchsia line. That horizontal fuchsia line is a 3% move. The up one, of course, would be an up move of 3%. The one down below is a drop of over 3%. And so if you can kind of use my crosshairs there with your eyes, you can see that you would have to go all the way back to this crazy candle right here on June 11th to find the last day that we had as bad of a day as this. We had a few other 3% drops along the way. You know, we had June 24th, we had looks like September 3rd, and then we had September 21st, September 23rd, and then one more right here on October 28th. So it's not that this is completely unheard of. We've seen those 3% down days, but they are fairly rare. And in this large of a meltdown, we haven't had it on the Russell 2000 small caps since going all the way back to June. For the Nasdaq, if we were to look at the Qs here now, you can see that this is the worst day that we've had since October 28th. On that particular day, we were down about 3.89%. The Nasdaq here today was down about 3.5%. So again, just another sign that, hey, it's been many, many months since we've seen moves like we saw here today. With the S&P 500, it wasn't quite as bad. So like if I pull up the SPY here, you'll notice that the SPY did not come down to touch that pink line like we saw with the RUT and with the Nasdaq. So not quite as disastrous there for the S&P 500. Nonetheless, it was a 2.4% down day, and that was our worst day that we experienced going back to, looks like it was October 28th right here. It looks like this day might have been close. This was January 27th. It looks like we were down 2.44% there. So yeah, actually this one on January 27th was slightly worse than what we saw here today for the S&P 500. So maybe not quite as bad for a broader large cap index like the S&P 500. Nonetheless, we had really ugly price action here today, and a lot of it led by those big tech companies that I mentioned previously. Now, no surprise, the VIX popped here today. So this purple line down below will show us what's going on with the VIX, and it ended at around 28. Some of you that were following me on Twitter today know that I posted it when it was right around 30. So it did touch 30 at one point. And as I mentioned on Twitter, that makes me excited as a put seller, somebody that is looking for opportunities to sell puts on companies that I admire, that I wouldn't mind owning at a lower price. Rising volatility can help juice your returns up front in the credit that you're receiving, because theoretically you're taking on additional risk. The market is more nervous today than it was yesterday, so volatility prices are rising and therefore making put prices more expensive. And so if you're a seller of puts the way that I traditionally am, that can be a good thing for you, assuming that you don't think that there's going to be a big market crash in front of you or something along those lines. So anyway, you always have to do your best to try to stay positive with your mindset, and obviously days like today can be difficult for some folks, particularly those that might have just started investing here more recently, but this is par for the course. We see days like this occur. This is not some sort of stop the presses type of a moment. It is something that feels a bit uncomfortable to people, but markets that go straight up are not considered healthy. You need pullbacks along the way to kind of reset the deck. And, other people that are panicking out of their positions, perhaps that presents an opportunity to you if you're finding the right type of a situation there. Let's get into some of our more traditional charts now. Coming on over here to chart 4B, and this will be our foregrid to help us identify, what the intermediate posture is for these various indices. And we have some new information to share with you here today. On Tuesday, you'll recall that at that time, the S&P 500 was still hanging on to its bullish posture. that changed. We now have a bearish posture on the S&P 500 according to the market forecast technical indicator. Now specifically, the indicator that I'm referring to is down below here, and we're using this green intermediate line to help gauge what our posture is. You'll notice that today, that green line fell out of the upper reversal zone and is now trading below the upper reversal zone. Remember, on the market forecast, the upper reversal zone is at 80, so it's a little bit different than a traditional stochastic technical indicator that has its upper reversal zone at 75. So at this particular case, we fell from yesterday being at, it looks like it was 80.63 yesterday, down to close at 74.03 today. And in doing so, fell out of the upper reversal zone. And that is the first time we've had a bearish posture since back here in early February. So we'll see where this takes us. The good news is the last time we had a little bit of difficulty in the market where we went to that weekly bearish posture, we only had to suffer through that for a few days before we were back up into that uptrend. But many of you are aware that this market has been in rally mode for many, many months at this point. Obviously, we're only looking at 3 months on these charts here, but since bottoming last March is almost a year at this point that we've been in a significant rally mode. And so, the further you go without a major pullback, the more realistic it is to keep your expectations in check, where you're not assuming there's going to be some sort of a blast off from this point forward. We kind of have to earn our keep. Usually there's at least one 10% pullback every single calendar year if you were to go back through history. Sometimes you might not have any for one calendar year, but you might have two 10% pullbacks in another year. So it averages out to at least one per year. So is this the start of that? It's possible. We've certainly seen robust price activity lead to speculative behavior, and sometimes people need to get their wrists slapped when they start sending stocks like GameStop up 100% in a day for no apparent reason, right? And that sort of thing that we've been seeing here recently. So we'll see where it takes us, but what we do know is that the posture setting mechanism that we use for this video now has us with a weekly bearish posture. It's not strongly bearish. Remember, it doesn't become strongly bearish until the green line comes down below 50. Right now, with it at 74, we would just consider this weekly bearish. And as I've stated in these videos in the past, whenever we have that, I kind of think of them as like storm clouds. We know that they're there. They're there as a warning. We don't know if they're actually going to lead to a legitimate storm or whether they'll just blow away and we'll have sunshine again. So we'll monitor that on a day-to-day basis, but naturally we become more concerned when there's more levels of support that are being broken along the way. And it is a little unfortunate that we closed below the 30-day moving average here today. We haven't done that for a while. The last time we did that was about a month ago. We've recovered from that the very next day. We'll see if that happens again tomorrow or not. But in this case, the one saving grace, I guess you could say, is that the moving average line is yellow. What that indicates is price is below a rising moving average in this particular case. So the moving average itself continues to rise. Maybe not at quite the same ascent that it was back here. You can see it's kind of flattening out right here, but at this exact moment in time, it is rising. And so if we were able to get some sort of a bounce out of the stock market tomorrow and we closed just a hair above that moving average, the moving average would turn back to green. There's no guarantee that background color would turn back to green, but at least the moving average itself would. So there is definitely more wear and tear on this market right now. There's, you've got to be realistic with the situation. And, while we all want and hope for stocks to keep on going higher and higher because it usually helps our long-term positions, we also have to be realistic with our understanding of what typically happens in the market. And we've had extremely robust gains that we probably didn't fully deserve, right? If you're looking at, the last year, we have a 23% increase. Typically, the stock market only goes up about 8 to 10% on an annualized basis. And keep in mind that this 22% right here includes a 35% meltdown along the way last March. So these gains that we've all seen here in the last several months have probably been larger than we deserve in many cases. And therefore, if we need to give some back right now, I, for one, am not going to be overly upset about that we have plenty of gains that are built into our accounts. We can afford to give some of those back while we wait for the markets to reset and become a little bit healthier again. With the Nasdaq, it's even more concerning than what we saw with the S&P 500. I mentioned the Nasdaq was down a lot more today, right? It was those big tech stocks that suffered the brunt of today's selling, and so S&P 500 was only down 2.45%, but the Nasdaq was down 3.52%. That's a pretty extreme difference, more than 100 basis point difference there in the drop that we saw between those two indices today. And in that kind of vein, it makes sense then that the background color of the Nasdaq chart, this is the Nasdaq composite here, so it's not the Nasdaq 100, it's the Nasdaq composite. It's going to include a lot more stocks, but you can see here that it has turned to dark pink. So that's the first one during this particular sell-off that we've had in the last couple of weeks to go to that dark pink status right there. And not only that, but obviously broken support as well. This is the type of behavior you don't want to see. So let me right click and go to maximize so I can share this with you. When you see the Nasdaq crack below its moving average like this, you kind of want to maintain your calm demeanor to see if it can snap back. And there was some optimism that could have happened. Yesterday was a pretty decent rally day. Yesterday we popped back above the moving average. Notice the moving average was yellow, then it went back to green yesterday because yesterday's candle closed above that moving average, which was still rising. And not only that, but it closed above the prior day's high as well. So that is usually constructive behavior. And you're hoping that this was kind of like shake the weak hands out of the system, and then we're off to the races again with the strong hands. Today's activity surely does not calm your mind, because now the way that you're kind of thinking about this is you had this slicing breakdown of the 30-day moving average. You pop back above it, but just barely. And then today, you gave up that entire yesterday's bounce day and then some. Now it's starting to look like it's using the moving average as a resistance area. That becomes more concerning, right? And you can see that the moving average itself is starting to flatline here. So the more time you spend below that 30-day moving average, the more it's giving you the impression that it's no longer using it as support like it did over here. It might be starting to use it now as a resistance. So it is much more concerning what we see here with the Nasdaq composite. And then I mentioned the Russell 2000 was actually the worst performer today, down 3.69%, but its chart doesn't look nearly as bad as the Nasdaq's. The Russell 2000 has been on such an incredible move in recent months that it can have some pretty ugly give back days like this. You can see that we're still above the rising moving average, in this case with the Russell 2000. However, like the S&P 500 and the Nasdaq, we now have a bearish posture on the Russell 2000 as well. This one would be considered weakly bearish. Again, that light pink background color. So that means the only chart left on the board that has a bullish posture is the boring old Dow Jones Industrial Average. And it's not like that is doing great. You had a bearish engulfing candle here, a pretty ugly one, and it was down 1.75% on its own today. Now that looks good in comparison to the other indices, but a 1.75% move in the mega caps is still a pretty ugly day. Having said that, notice that yesterday we had an overbought cluster signal on the Dow Jones Industrial Average, so we should not have necessarily been surprised that we had this reversion to the mean type of a move here today, but we kind of have back-to-back signals on back-to-back days. Yesterday it would have been closer to a sell signal, depending upon how you approach things with those overbought cluster signals. Today, you might actually be able to look at the Dow Jones and say it's a bit of a buy signal. The reason I say that is because you now, with today's sell-off, have what's known as a bullish intermediate confirmation signal on those mega caps. You have the green line in the upper reversal zone telling us that we have a strongly bullish trend on our hands. And at the same time, we have a nasty of enough pullback day here today where that highly sensitive red line is in the lower reversal zone. So if you're in the mindset of buying the dips, then this is the type of thing that you try to take advantage of there. Whether that is a smart idea or not, only time will tell. You can imagine that If the other indices continue to suffer pressure because they now have weak bearish postures, and in the case of the Nasdaq, strongly bearish postures, then you set up the possibility that those other indices selling also drags the Dow Jones down with it. So we'll see if that happens or not. But on a standalone basis, you do have a bullish intermediate confirmation signal there on the Dow Jones Industrial Average. Let's take a step away over to the internet. I always like to get an opportunity to say thank you to those of you that help support this presentation that David and I do for free for you there on YouTube. So the last time around when I did it on Tuesday, thank you to everybody who helped support it. 123 likes there. Anytime we're up and over 100, I am thankful for that, and I don't question the value and the ability to do these videos for you on a timely basis. We start getting below 100, then I start questioning that. But you guys have been great, and so I've got no complaints there. Keep it up. It only takes 5 seconds for you to help support us, and if you want these videos to continue to be done, I think most of you agree that it's worth your effort there as well. Also, while we're over here, I did teach my question and answer session earlier today. So for those of you that are premium members, if you're interested in my thoughts on Santander, if you're interested in my thoughts on UGI, which is a natural gas utility, if you're interested in my thoughts on People's Bank, which we had some really great news on that company earlier this week. People's Bank, a dividend aristocrat, is getting bought out by M&T Bank. So many of my students do own People's Bank. So we had the conversation on whether we should let that get converted into M&T shares. So if you're interested in that conversation, check that out. We also had a long discussion on Sonoma, a stock that has just been dynamite, and they are operating at a very, very high level with their business right now as well, according to some of the indications we're seeing with the earnings numbers and the cash flow numbers. And then we also had a question on Evergy, another utility company from a dividend growth investing perspective. Also, while we're over here, Factor Selector put this together on Tuesday night, and so just wanted to point out while we're talking about, where is the market rotating to, one thing that is becoming very obvious is momentum is really falling out of favor. And I know that firsthand because I'm seeing the results from our top-down trend trading class, which had been, firing in all cylinders for a very long time. And then the last several days, we've been getting beat up pretty badly in that particular class. So we'll review the damage in class on Monday when we gather together again. But just be aware, those momentum stocks are really falling out of favor here in a big way compared to the other style factors that exist out there. Low size is hanging on for dear life, but after what we saw here today with the Russell 2000 getting clobbered the way that it did, it is possible that the next time I do the Factor Selector update next week, I wouldn't be entirely surprised if value replaced low size up at the top. So we'll keep our eye on that, and it is also possible that momentum replaces low volatility on the bottom. That would be big news as well. As you can see here, low volatility has been the worst performer on a factor basis for over 3 months at this point. But the way that momentum stocks are getting hit so hard right now, I will not be surprised if momentum replaces it at the bottom next week. Now there's a few days between now and then, so if we get a little bit of a bounce in the market, that doesn't have to happen, but that is kind of what we are seeing in terms of transitions within the marketplace right now. Also, I mentioned this slide on Tuesday, but I'll mention it here on Thursday as well in case we got a few folks that weren't able to watch the presentation. I've been sharing it in my premium classes earlier this week as well. But if you are one of our original 2018 premium subscribers, so all of you that were our charter members when we started off at Market Scholars here, it's been 3 years now since we started. It was March of 2018 when David and I kind of went out on our own. If you were among that original batch, remember your premium subscriptions are coming due on June 30th. And so we're doing this sliding scale renewal discount for all of you that were part of that initial crew. And so this is the final week that you can earn the 25% off. Starting on March 1st, that will drop down to a 20% discount. So wanted to mention that just in case some of you aren't receiving our emails or what have you. At least you're aware of it if you want to take advantage of it. And that web address that you see up at the top is where you would go to get your renewal done. That is only available to those of you that are the original charter members. So the rest of you that are trying to go to that web address up there, you won't be able to see it, but everybody else who's eligible will be able to see that. All right, let's get back on track with some more charts here. Let's take a look at the 3 green arrows chart. I'm assuming that we probably have some 3 red arrow signals, but let's just see if we can verify that here. Yeah, and we do. We've got 2 charts that have 3 red arrows at this point. We've got the S&P 500 with a 3 red arrow signal, and we've got the Nasdaq Composite with a 3 red arrow signal. Both of them had earned the fresh signal today because their price fell below the moving average and earned that red arrow right there. The MACDs and the stochastics were already there, so we already knew that we had a loss of momentum. And by the way, with that question that I answered for Linda in the Q&A class today, I did have a little bit of a lengthier conversation about what are we using the MACD and the stochastics for? What is their importance to trend traders? So if you're one of our premium members and you want to have access to that conversation, just check out my Q&A class recording earlier today. But basically, it's a way for us to judge where the momentum of a particular security is right now. And across the board, we do have red arrows on the MACDs across the board, and we nearly have red arrows on the stochastics across the board. The only exception there is the Dow Jones still is retaining its green arrow on the stochastics, even though it did go to a red arrow there on the MACD today. So that's new information for you. S&P 500 and Nasdaq Composite, both with those 3 red arrow signals. Let's go ahead and pop on over to some 12 grid analysis now, starting with chart 5A. This is our asset class 12 grid. You can see here it's more pink than green. However, with this first set of 12 grids, remember, these are such widely diverse different groups that there's oftentimes lots of mix of green and pink on this one. It's when we get over to the sectors where sometimes things can cluster up a bit more. Anyway, the big story of the day, or one of the big stories today, was what was going on with the 10-year U.S. Treasury yield. And you'll see down in the lower right-hand corner that particular chart. Now remember, this is the one where I've sounded like a broken record for months at this point, kept on telling you, if you replaced TNX with any ticker symbol of your favorite growth stocks, you would be salivating over this chart. So this is not new information. Hopefully all of you that have been watching these videos is well aware of what's been taking place here. We have seen rising interest rates for quite a long time. However, today was important because of what happened in relationship to the S&P 500. The S&P 500's yield and the 10-year Treasury yield have now officially crossed. If I were to come up here, one of the charts where we show those two things next to each other happens to be the dividend stair-step chart. So let me just step away for a second and show you the closing numbers of those two yield entities. Up here on the top of our dividend stair-step charts, you're going to see kind of a blue label and a maroon label. And you'll notice the S&P 500's dividend yield is 1.49% at this moment in time. The 10-year Treasury yield is 1.52%. So today was the first time in many, many months, if not years, where the 10-year U.S. government interest rate is now higher than the S&P 500's dividend yield. So there was maybe a little bit of fear in the marketplace of a trade-off effect that could happen, where investors who are investing for income might start switching their allegiances from the stock market back over to the bond market now that they can earn more money and interest from bonds, government bonds, than they are able to in the stock market. I don't know how legitimate that argument is, but it's a storyline nonetheless, so I thought I would point it out to you. That was a pretty big moment, and we haven't seen that for quite a long time. Let's get back over here to that to the 12 grid again. So that's chart 5A. Let's see what else is going on. So, obviously yields going up mean that bond prices are going down. So once again, we saw long-term U.S. Treasuries. I mean, that is one of the worst and most consistent downdrafts you're going to find in the government bond market. I mean, that is like day after day after day after day. This thing cannot catch a bounce, despite all of those oversold cluster signals. Typically, in the past, when TLT had received oversold cluster signals, you would have received a bounce by now. So it's very peculiar. This selling pressure within the bond market has been so consistent, it's kind of defying normal technical analysis that would affect it previously. You'll also find that foreign bond market is also falling off of a cliff. Talked about that a couple of weeks ago on this candle where we had kind of these back-to-back air pockets right here. Well, it's just continued to get worse. Today was the worst of them all. That candle is the ugliest one on the board from a foreign bond perspective. Here's something that's real interesting. That was not the case. You guys are aware of this because, that's something I've been harping on for a while. This is a bit different. The high yield bond market got absolutely trounced today. Many of you have heard me talk about this before, but where we've talked about it is how it has held up and done better than these other bond areas because so many of those junk bonds are issued by oil companies. And with oil prices going higher, it's kind of helped save the junk bond issuers. Well, it seems like that was thrown out the window today. Junk bond market was down nearly 1%. That's the ugliest candle on the board. So this is one of the major storylines here today. Bonds across the board got bombed today, and interest rates really surged. That could mean we've got some inflation heading our direction. We'll see. But that was a big takeaway from today's trading activity. We did see that the U.S. dollar stabilized today, had a pretty healthy up day there, up 0.33% on the U.S. dollar, probably viewed as kind of a bastion of safety in a chaotic market day. You'll notice that Bitcoin sold off about 5% today. So, Bitcoin has been rising as a speculative asset. I don't know if you can really make the claim that it's a store of value or a place where you're going to hunker down for safety, however. Perhaps one day, but today it didn't prove that out. Today it was down 5%. Gold didn't really prove that out either, for what it's worth. Gold was down 1.88% today. Now, part of that might have been because the dollar was up. A lot of times when the dollar's up, commodities go down, and we did see that with both gold and oil here today. You will see that on the top of the board, all of these stock-based charts are to the downside. And that includes the once ever hot EEM, emerging markets. I mean, that's still a really strong performance over the last 3 months. They're up about 10%. But we have something new to report on the emerging markets today. Today was such an aggressive down day. We were down 2.28% on EEM that it actually changed the moving average from yellow to red. So the moving average has started to come down because this has been a pretty sharp sell-off in the last week and a half. And so enough of that selling activity is embedded within this 30-day look-back period that is embedded within the moving average itself, that you're actually seeing that get pulled down right now. So again, kind of the same conversation as what I had with you earlier about the Nasdaq composite. That's not a great sign. You start seeing the moving average being used as resistance, you start seeing a little bit more uncomfortable trading activity within that area. It looks like EFA is holding up a little bit better. It did close a little bit below the moving average, so you can see the moving average turned red there as well, but you can see that it does look quite a bit different than EEM, which really cut through that moving average, whereas EFA could easily close right back above the moving average starting tomorrow. You'll also see that preferred stocks got whacked yet again as well. And remember, that's part of that interest rate story there. So when interest rates have started to surge here, it starts to impact a lot of those income-oriented areas more negatively there. So that has been in play for the last couple of weeks as well. And I've brought that up to you guys. So that's not anything necessarily new. So I guess the new information, the new takeaway is what happened with the junk bonds. That was abnormal. That had kind of broke something in the system that was not necessarily the case in recent weeks. So now junk bonds all of a sudden are acting like some of these other income entities. If we were to look at some of the sectors now, let's take a look at chart 5C here. And as you can see, it's a little bit more of a mixed bag here at this point, despite the selling today. I'm actually a little bit surprised. I kind of had a feeling that if we came over here, we'd see a lot more pink charts and very few, if any, green charts. But there are still some green charts holding on for dear life. Now, every single one of these sectors was down today. So there were no winners. There were just relative winners that are out there, I guess you could say. The utilities were down, but they were only down 0.9%. And so they're kind of playing the safety role here today, where money was transitioning out of some of the riskiest areas like discretionary down 3.7% as the worst sector today, and then technology just behind it at 3.5%. So money was maybe rotating out of some of those more cyclical areas and hunkering down in kind of the more monopoly structure of the utilities themselves. Now, having said that, the utilities have been out of favor. And so while they were down the least amount today, it's a continuation move of the selling that we've already been seeing in them. You'll notice right here, the utilities actually received an oversold cluster signal today. So on that email I send you a little bit later today, I'm sure we'll see quite a few individual utility stocks show up on the list of oversold cluster signals. One of the things I was pointing out to my class today was that Con Ed has an oversold cluster on a weekly candle. And you don't see that very often. Maybe I could transition to that right now since I'm about to head over to Dividend Stair-Step chart for my trade application anyway. But before we get to that, I'll show you the Con Ed chart. It's ticker symbol ED. And you'll see here that as of this exact moment in time, Con Ed is sitting in the blue zone of the Dividend Stair-Step chart, meaning that its current dividend yield is viewed as attractive compared to historical circumstances. And you can see that it's got this little green dot showing up to the left of my cursor there. And what that signifies is that this company has a oversold cluster signal on the market forecast technical indicator on a weekly candle chart. Remember, normally in this video, we're showing you daily candles. So it's even more rare to receive oversold cluster signals on weekly charts, and even more rare than that to receive them on monthly charts. But anyway, you can see here that Con Ed has been a very good example of a company who, when you take advantage of it, when it's in the lower reversal zone, it has been a wise idea. Can't say for sure it's going to be wise this time around, right? The future is unknowable. But what I can say factually is that it would have been wise in the past to take advantage of a situation like that. You can see it had an oversold cluster signal on a weekly candle back here in November of 2012. It did it again right here in September of 2013. In December of 2013, and then one more time right here in June of 2015. And then it went off to the races along with all the other utility stocks where they remained overvalued for a long period of time up until recently, where it's now become attractive again for those of you that are looking to lock down a dividend growth stock, in this case a dividend aristocrat company, for the long term, and looking for kind of dividend reinvestment plan, reinvestment type of situation there where you're adding to your investment over time. Now might be an interesting time to consider that for Con Ed. But our trade application example today is actually not going to be Con Ed, it's going to be Pfizer. Let's pull up that chart here on our Dividend Stair-Step chart. Unlike Con Ed, Pfizer, you can see, is not trading in the lower reversal zone. In the blue zone of the Dividend Stair-Step chart. It's up here, kind of what I would call in the neutral zone, kind of in the white, between the orange and the blue. And so for Pfizer, typically throughout history, if you've been able to lock down a yield of 4.86%, it has been an attractive trade-off. You can see that that occurred a couple of times last year during the coronavirus selling, and it also occurred back here about a decade ago when it was trading at about $16. That would have been an awfully good time to be considering it. We're not there yet. It would have to fall down here to $32.10 for us to tackle that yield of 4.86%, but we're close enough right now with a yield of 4.61% where this is the type of chart that gets me thinking about selling puts. In other words, I don't want to buy the company right here, right now. Not to say that it couldn't go up from here. It very well could. But sticking to the rules that I try to teach to my students, our rules would suggest that we need to get filled at a price somewhere below this blue line. And so by selling a put, it opens up that possibility of me being able to buy this company at a cheaper price if it continues to fall. If it doesn't continue to fall, then I get to keep the credit that I receive up front when I sell that put. So what we'd want to focus on is a strike price at 32.10 or less. And what I opted to do as I come over here to the trade tab is I opted to go with the April monthly contracts, and we're looking at the $31 strike, which is obviously below $32.10. So if we were to eventually be filled on our position at $31, then we would effectively have a yield in excess of 4.8%, and therefore attractive for long-term purposes. But I wanted to share something with you that doesn't happen all that often. And when it does, it's kind of a light bulb moment for a lot of students that I've taught over the past, because they've never really fully understood how the options pricing model tends to work. And I always like to remind folks that there are 3 different things that go into the options pricing model: price, time, and volatility. When you're a put seller, the time component of that helps you every day. And that's why you'll hear us say things like, you make money off of time decay. Basically, time will continue on, and the portion of the options contract price that is time will basically benefit you the longer you're holding an asset that's wasting away, because time is ticking away. And so that portion of the options pricing model is benefiting you each and every day. Another part of it is price. Price tends to benefit you if you're doing a bullish trade like selling a put, if the stock were to go higher, right? If a stock goes higher, its put price goes lower. If you've already sold the put at a higher price, you want its put price to go lower, because that means that you are collecting the difference between where you sold the put somewhat expensive versus where it would be in real time, hopefully somewhat cheap. And you control the difference between those two things. And that's what makes this an interesting educational example. Pfizer was actually one of the very few companies that closed in the green today. The vast majority of companies, as I mentioned before, 7-1 today to the downside. 7 down stocks for every 1 that was up. Pfizer was one of those. It was only up 7 cents, so we don't want to make too much of it. But it's interesting from an educational perspective, because remember, traditionally, if a stock goes up, its put prices go down, for the reasons I mentioned just a moment ago. That didn't happen today. And so that leaves one more portion of that options pricing model, the volatility aspect, to be basically fully responsible for what happened with this security today. You'll notice here that the last traded price of the $31 put was 37 cents. You'll also notice that was up 9 cents from yesterday. Remember, normally if a put is going to go up, it's because the stock went down. That didn't happen here. The stock went up, yet the put prices also went up on a percentage basis a lot, right? 9 cents on a 37-cent underlying is a huge percentage move. So we know that time benefited this from yesterday, so the time decay component worked just fine. We know that price did not send this higher, because price of the security would have had to go down if the put was going to go up. So that means it was volatility that forced this put price to go higher today. And therefore, back to kind of circle back to what I mentioned before, that's why I get excited when the VIX soars the way that it did up to nearly 30. What that's saying is that implied volatility across the board is surging across stocks that might not even deserve it, right? Again, Pfizer was up today. There was no additional risk with Pfizer today. There was risk in the market. But because the VIX was going higher, it's basically creating this domino effect where implied volatility was going up on almost all stocks today, regardless of whether there was actual risk in them or not. And so on the whole, when you get to sell premium on a day like this, you're kind of getting to sell premium on something you don't deserve to. Normally, if the put is going to go up in its value, it means the stock is getting clobbered. And therefore, you are sure taking in some credit, but you are basically having to earn your keep by assuming that risk. Today, you are able to sell premium on Pfizer, and you didn't take on any additional risk from where you were yesterday. In fact, the stock was up today. So a very unique example there for people who in the past may not have understood that it's not just price that controls options activity. There is also a time component and a volatility component. And this is case in point right here, where it was the volatility component that created the very abnormal circumstance with Pfizer and your ability to sell a put in it here today. So if we are able to get this transacted, what we would need, and by the way, the trade is already done, and I've sent that out to you guys via Telegram, as I always do if you're a premium member. But in order for us to be able to lock down Pfizer at $31 per share, we would need the stock to fall down to 31 and close below there on expiration day in April. And that could very well happen. That's not all that far away. So that's entirely possible that that could occur. But if it doesn't, then we will keep the premium that we received when we sold the put here today. But I really wanted to share that with you because it was such a unique example. It doesn't happen all that often, and it typically requires some sort of a major market meltdown type of a day like we had today, and it's going to affect all stocks out there from their options pricing perspective, even if they don't deserve it. And Pfizer didn't deserve it. They were up 7 cents today, yet their put prices were surging, and so we might as well take advantage of that by being the sellers of overpriced puts like we were in today's trade application example. So I do apologize for the length of the video tonight, but because of that educational circumstance there at the end, I felt like it was important for us to kind of gather up all that data, help you guys understand that process a little bit better there as well. If you appreciated that extra effort, make sure you click like for me there on Twitter. That's the only thing I ask out of you. It only takes 5 seconds out of your day. As far as I know, David should be back with you here tomorrow or over the weekend, and then I'll see you guys all next week. Until then, I want to wish you all the best of success with your trades and your investments. Goodbye for now.